The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and welcome to session 3 of the Lean Accounting Introduction to Lean Accounting webinar series. My name is Nick Katko, and I am actually going solo today. My assistant, Susan Lilly, is unable to make it. So let me just give you a few housekeeping items. As we go through the webinar, if you have any question, please write your question in the question section of your control panel. And at the end of the webinar, I'll get to as many questions as possible. Also, remember to download your handouts from the handout section of your control panel. I actually have all 5 handouts from all 5 sessions in case you've missed some of the earlier handouts. And finally, a recording of this webinar will be distributed tomorrow to everyone who is registered with a link to the recording. If you have any questions or problems with the recording, please contact me, and I have alternate ways to get you the recording. So let's get started. Today, we're going to be talking about the value stream income statement. What is a value stream income statement? How do we create one? Why is it important? And how do we use it? So, our agenda today. What is the issue? Why are value stream income statements important to lean accounting and lean businesses? We're going to spend a little bit of time talking about value streams. Now, value streams it's a lean practice. It's important for people who are new to lean accounting and new to lean to understand the concept of the value stream so that they understand the concept of the value stream income statement. I'm going to talk about the fundamentals of a value stream income statement. We'll spend a little time. How do we analyze the value stream income statement in terms of understanding our costs? Then we'll wrap up and we'll get to some questions as time is needed. I would also like to say at this point that the session on Thursday about lean decision making, we will be talking more in depth about how you use the value stream income statement in conjunction with the box scores and making lean decision making. So what is the issue? So let me give you an example, and if you've worked in a manufacturing company that employs standard costing systems and uses a standard costing based income statement, you have probably encountered this situation. So here we have period 1 and period 2, and we have some very simple income statements here. If you look at period 2, you see that the revenue was greater than period 1. However, if you look down to the net profit line, the net profit of period 2 is less than the net profit of period 1 by a significant number, almost $100,000. Now, many of you have probably encountered this situation. And this is one of the more frustrating aspects of using a standard costing based income statement, is the fact that the revenues and the costs and the margins don't always seem to line up. And then you throw in the variances, and you can see the different variances listed here under the adjustment section. And these variances, again, understanding the relationship between the variance and the revenue, or the variance and the cost, is very, very difficult. In my experience, way back when in the 1990s as a CFO, before I discovered or started using lean accounting, I encountered this situation many, many times. And in my years of doing lean accounting consulting, I've talked to many people in many companies, from senior level executives to operational people, who really just can't get a grasp on these statements. In fact, more than one company I've talked to, they adopted the position of, well, we're just going to ignore the variances. However, they're there and they do have a financial impact. So this is a very difficult income statement from an internal use to understand. So let's look at period 2 in the context of a value stream income statement. We don't have period 1 here. We're just trying to understand period 2 and why is the profit much less than period 1, even though revenue is greater. So first of all, if you look at the total column on the right, you see our sales, 2,048,686. Now what you see in the cost section are the actual costs incurred for the period. And they're broken up by the value streams. And we have 3 value streams here: OEM, systems, and new product development. We have 2 value streams: OEM and systems. Then we have new product development, sales and marketing, and support. In this situation with the value stream income statement, we are showing the actual costs. Let me just pause for one moment, since I'm working by myself, and I just wanted to make sure we didn't have any questions or problems with the audio. If you go down to the value stream profit line, you see that the operational profit for this company was $322,610. And that's really what we want to accomplish with the value stream income statement, is accurately show operational profit. The primary reason that the net profit was less than period 1 was the inventory valuation issues. If you look at the inventory adjustment section, you'll see that inventories went down by almost $223,000 compared to period 1. Because the inventory went down, that has an impact for external financial reporting purposes. So that is the main reason why profits in period 2 were less than period 1. However, this income statement, the value stream income statement, does show that operations did do its job for the period. They shipped more product and they brought in more operating profit. But the financial reporting requirements require the inventory adjustment, and that's the reason why. Over the course of the years of teaching and training people on value stream income statements, what I found is that lean operational people love the value stream income statement, and financial executives love the value stream income statement. And it's very important to get value stream income statements into your lean business sooner rather than later. So the problem is that standard costing based income statements, they drive anti-lean behavior. When you use overhead rates and overhead costs, it assumes that there's a direct relationship between overhead and labor, because typically your overhead rates are based on how much direct labor you have. And that simply isn't true of all your costs. Your costs don't vary based on direct labor. Also, standard costing based income statements drive the mentality that to maximize profits, maximize utilization of resources. This gets into the overhead absorption issue. If we just absorb a little more overhead this period, we can make more money on our profit and loss statement. And finally, looking at costs. We develop complex cost analysis systems to track actual costs compared to standard, and also to maximize the production process at each process step rather than the value stream as a whole. So in a lean business, we do not want to use standard costing-based income statements. The short conclusion to reach here is that they are not compatible. So if you're just getting started in your lean journey, or maybe you're established but you still have standard costing-based income statements, it's really important to know that in the long run, you're going to have compatibility issues. Standard costing-based income statements are going to give you the wrong information to analyze how financially viable lean operations is really doing. So this is why we want to transition to a value stream income statement. And I'd like to say this here right now, and I'll repeat it a few times. Value stream income statements are used internally for internal financial analysis. You have to continue to report according to generally accepted accounting principles or international financial reporting standards for your external statements. Now, this doesn't create a second set of books. This doesn't create a separate accounting system. All of the numbers from a value stream income statement come out of the general ledger. What I'd like to say is that a value stream income statement is just taking all the numbers in the general ledger and showing them in a different format that's understandable to internal lean operational people. So let's talk a few minutes about value streams. If you have familiarity with the 5 principles of lean, value streams are one of the principles of lean. The reason that value streams are one of the 5 principles is that lean companies identify value streams, they organize around value streams, they control by value streams, they manage by value stream, and they improve by value stream. I like to say that the value stream is the foundational organizational unit of a lean company. From a financial viewpoint, it's important to understand that value streams are the profit centers of lean businesses. It's not business units, it's not departments, it's not products, it's value streams. The reason being is we flow the work through the value stream to satisfy our customers and create value. So I want to spend a little bit of time explaining value streams. This is primarily intended for people who may not be familiar with value streams or just getting started with lean. But it's important to understand value streams so you understand the concept of the value stream income statement. Value streams really are coordinating work to create flow. And the definition of a value stream is what are the actions that have to be taken in the proper sequence at the proper time to create value for your customers. And in addition to the actions and the work, it also includes the coordination of information to drive the actions in the proper sequence and at the proper time. So that's what a value stream is. The primary value streams of lean businesses are called order fulfillment value streams. And underneath the heading here is really the detailed definition, explanation of what a value stream is. So order fulfillment value stream includes all of the actions to process customer information from receipt of an order. So that means, when does the order arrive? That is the beginning of the value stream. Before an order even gets into production, if it's a manufacturing or operations, if it's a non-manufacturing, there might be some design work, there might be some configuration work. All of those functions are part of a value stream. So once you receive the order and once maybe you design and configure, you now really go into what we would call normally the production process. And this includes all of the actions to transform the materials into the finished product so that this finished product can be delivered to the customer. So, for example, these are, again, just general manufacturing steps. It would include the machining process, the painting process, final assembly, and then shipping and delivery. So whatever your manufacturing process is, these are the primary steps of transforming materials into finished products. Most importantly, and people sort of get this in terms of a value stream, but most importantly, the value stream also includes all of the other activities required to support the transformation of the order into a finished product for delivery. So what this means is that from a traditional manufacturing standpoint, when we talk about indirect functions or support functions in a lean organization, these functions are really part of the value stream. So for example, the purchasing process. Yes, that is a separate department, but it really is part of the activities which are required to support the order fulfillment value stream. The quality process, the maintenance process, the engineering process. So all of these functions really should be integrated into the order fulfillment value stream. Now, we could spend a whole lot of time talking about how this gets done and why this gets done, and I'll probably do a webinar on this in the future. But right now, it's important for everyone to understand that a value stream is not just the direct functions, as we like to talk. It is all of the functions which are required. And depending on how many value streams you have in your company, it's important that these support functions get integrated. The typical way to identify value streams, and again, this is just one simple slide to give people an idea, is you follow the product families that have similar flow through your business. So you look at your product families and you actually walk the floor in your factory and see which ones have common process steps and resources based on the material flow. You may also have some monuments, which are resources that are shared between value streams, but typically this is how value streams are identified. So that being said, let's move into the value stream income statement. So the standard work to create a value stream income statement, you could also think of this as maybe the principles of a value stream income statement, is that we are trying to measure value stream profitability. Value streams are the profit centers of businesses, of lean businesses, so that's how we want to look at profitability. We really don't want to drive profitability analysis below the value stream level, because that's where you start getting into how do we assign costs to business units or certain product families, things like that. Secondly, we want to use actual direct costs. These are the actual direct costs that are incurred by the value stream in the period being reported. We want to minimize allocations. Allocations are subjective. They're not always accurate. And again, we'd like to eliminate all allocations. In reality, the goal is to try to minimize allocations of costs. Value stream income statements do not use standard costing information. We want to use actual cost information. We are seeking operational accuracy for internal use. So I just want to pause here and elaborate a little bit. And I'm going to talk some financial accounting to everyone. In your typical standard costing based income statement, you have your revenue based on the items and the products that were sold. What standard costing does is for cost of goods sold, it's the standard cost of the products that were sold in that period. Now, the reality is that the products that were sold in the period may have been made in a prior period. But those are the costs, the standard costs associated with the product sold. That cost of goods, that standard cost of goods number is not necessarily reflective of the actual cost of operations. And this is where the disconnect comes in, and this is why operational people, even in a non-lean business, don't understand standard costing based income statements. And this is why we get also the variances and the overhead absorption. So we're for internal use only. And remember, we're trying to serve our internal customers here from an accounting viewpoint. Operations, senior leaders, etc. We want operational accuracy. How much our revenue is going to be based on what we shipped, and our costs are going to be based on our actual costs incurred. Now, some of you may say that some financial people may say, well, that doesn't meet the matching principle. And I'd like to remind you that we're talking about internal financial statements for internal analysis. We're not talking about external reporting at this point in time. So let's look at the breakdown of a value stream income statement. And again, I'd like to repeat, we're talking about taking all the numbers out of the general ledger. We're talking about creating basically a new formatted income statement that is designed for internal use and designed for non-financial people. So we split our value stream income statement into the different value streams we have. In this case, we have three: motors, systems, spare parts. The value stream profit line is really the operating profit of the value stream, based on the actual revenue that we incurred and the actual costs of the value stream. Operational people, by the way, love value stream income statements. It makes sense to them on day one. We also have sections of the value stream income statement for costs that are not controlled by the value stream, whether it's new product design. Support costs can also be thought of as selling, general, and administrative expenses. So in this case, we create an operating profit of $209,678. So everything at the value stream profit line and above is under control of the value streams of the various functions of the business. The bottom box is really the financial adjustments that need to be made by accounting to bring a value stream statement into compliance with generally accepted accounting principles or other corporate reporting requirements. This typically would be the valuation, the change in the valuation of inventory. In this case, inventory went down by $6,507. This company also has a corporate overhead allocation system where they charge this division $51,000. So you get to a divisional profit of $152,000. However, this bottom section is not the responsibility of operations. It's just more informational to say, well, how did we get from a $209,000 operating profit to a reported profit of $152,000? So let's talk a little bit about actual direct costs. In a value stream income statement, material cost is the actual material that is consumed by the value stream in any reporting period, regardless of what was sold. It's what the value stream used. And when we get into analyzing material cost, you'll see why we want to use actual material cost. Labor cost. This is the actual cost of the people that work in the value stream. Now, if you remember from the value stream identification section, we talked about, for example, all of the support costs. So in a value stream organization, you typically take people, maybe like from purchasing or maintenance or quality, and they're assigned to a value stream. Those costs go into the labor cost. We are not concerned in a value stream income statement with direct and indirect people. We want people in the value stream, and that's the salaries and wages that are reported. Machine cost. This would be depreciation, the actual repairs and maintenance for the machines, tooling, and energy costs, if it can be assigned to machines. Materials, labor, and machines typically make up the overwhelming majority of your value stream costs. And these are the ones to concentrate on when creating a value stream income statement. You might have some facility costs such as energy, rent, maintenance, and repair. In a manufacturing company, you might have outside processing costs, in which case we want to understand what was the actual cost for the period. And finally, any other cost which is under direct control of the value stream, we would want to assign to a value as a value stream cost. Think about it this way. If the value stream is making a spending decision in terms of actions or whatever that's going to cause money to be spent, we want to try to assign that cost as much as possible to the value stream. Now, I realize some of you might be thinking about, supplies and many of the other line items on your income statement. And the creation of the value stream income statement is really a line-by-line exercise. I purposely didn't get into a lot of details, but when you're creating the value stream income statement, you look at all your expense line items and you try to understand how are these costs incurred, how can they be directly charged to a value stream or not. If not, put them in support. You may also have monument costs. And if you remember, a monument is a shared resource. It's a production process step or maybe a support function that is shared by more than one value stream. Here are some simple examples. You might fabricate the component parts from steel. You might get rolls, a company might get rolls of steel in, and the steel needs to be fabricated into different component parts, which then go into different value streams. That's a monument. If you have a painting area, typically companies that do painting, they have, or paint their parts, they have one area of painting, and all the products go through there. Another example, which is more of a support function, might be highly specialized quality testing. Maybe because of your products, the skill level required to do the quality testing is very high. For example, a production operator may not be able to do the test. In that case, quality testing may be a monument. So this is when we talked about minimize allocations. Typically, monument costs get assigned through a simple, logical allocation method. For example, in fabrication or something, the percentage of products produced for each value stream, that's where you would take the percentage of products produced for each value stream and assign the monument cost to the order fulfillment value streams. Now again, there's lots of detail behind this, but what's important to understand for this webinar is that you will have to deal with some monument costs. So let's talk a little bit about analyzing the value stream income statement. If you listen to the value stream performance measurement webinar last Thursday, we talked about what are the proper lean performance measurements to use. Now, lean performance measurements are used to analyze lean operations and let you know how operations are doing. An important aspect of lean accounting is to be able to link the lean performance measurements to financial performance. Now, this is a new area for a lot of the accounting function. Now, the accounting function doesn't do this by themselves. The best way to do this is through collaboration with lean operations and do it jointly. Accounting needs to understand the lean performance measurements. Finance needs to, lean operations needs to understand the value stream income statement. What lean performance measurements do is they give you a lot of detail about why your financial performance by value stream is what it is. The lean performance measurements can really be used as leading indicators for financial analysis. If you remember back on the introductory webinar on Tuesday, I talked about how lean thinking is about how are we doing today, what are the problems that are preventing from improved performance, and how can we get better tomorrow? And using the value stream income statement in conjunction with lean performance measurements actually gives you it gives you the insight you need, and it also creates leading indicators. If we improve our measures, what is the financial impact of improving measures? This is a very powerful tool of lean accounting, is combining these two practices. And it's the earlier that this is put in place, the more effective lean and improvement becomes. So we have our 5 general areas of performance measurements: improving productivity, improving on delivery, improving flow, improving quality, and improving lead time. So what I want to do is spend a little time explaining how we connect a value stream income statement to these measures. We're talking about true root cause analysis. We have our actual value stream costs, and we want to use our operational performance measurements to understand the root causes of our costs. And as you remember from the lean problem solving slide in session 1, if you understand the root cause of any problem, you can eliminate that problem. So what we're trying to do here is create this tight connection so that we can understand the root causes of value stream performance and change the financial outcome. So let's look at these cost relationships. Material cost. Material cost is the only true variable cost. It has a direct relationship with revenue. The more revenue we have, the more material we have in our cost of goods sold, in our value stream income statement. The less revenue, the less material. That is the relationship. Direct labor is considered a variable cost in a standard costing system. Sometimes even in standard costing systems, you have some level of variable overhead. Those are not true variable costs, meaning they don't vary with sales. Your labor costs and your machine costs are impacted by continuous improvement. And the relationship between the value stream income statement and your cost is your capacity. If you need more capacity in your resources, people or machines, your costs will go up. Unless and if you maintain your current level of resources, you still have the same capacity, you still have the same cost. Now, this is a very important shift in thinking about especially labor costs. Labor is not variable. It doesn't vary with selling one more unit of a product. Your labor cost is defined by the number of people you have and how much you pay them. And that's a function of the capacity that you need. When we talk about the capacity tomorrow and its decision making, you'll get a better idea of this. Any other value stream costs may not have a direct relationship with revenue, or may not, or it may. The important thing is to understand the root cause of each cost. So these are just general relationships to understand. So now let's dive in a little bit deeper here. So how can we use performance measurements to understand actual material cost and to understand how we can change the cost structure in our value stream income statement? You can do three things with materials in a value stream income statement. Remember, we're looking at material costs consumed. So if that material cost comes into the value stream statement, one of three things happens. Number one is the material can be converted and shipped. If your lead time improves, you have shorter lead times, you're going to have more revenue. And your actual material cost of goods sold will go up if your revenue goes up because it's truly a variable cost. This is good. We're not trying to reduce this cost at all. However, there are two other things you can do with material cost. You can scrap your material. It can come into the value stream and scrap it. So your leading indicator is your measure of quality. If your quality measure is improving or can improve, that will have a direct relationship on scrap expense or the material consumed. It will go down. So this is how we establish these relationships. Third, you can consume material, meaning the material can come into the value stream, but it can be stocked as inventory. The leading indicator is your days of inventory. If your days of inventory performance measurement is going down, you're going to have less inventory, which means the inventory consumed number will go down. That has an impact on the value stream income statement because your value stream profit will go up because you're consuming less material. The other positive financial outcome is your cash flow will improve. This is also one of the aspects of a lean journey, especially in the early stages of lean when inventories are being drastically reduced, where executives, senior leaders don't see the short-term impact of lean on a profit and loss statement because inventories are being liquidated and cash flow improves, but for external reporting purposes, profitability is not improving. So this is another reason why having a value stream income statement available where you can show that the value stream is consuming less material, and that is a good thing, and use that as the primary way to analyze how lean is working. If we look at our actual labor and machine costs, if we talk about just managing these costs in general, your value stream productivity measures are the leading indicators. If your productivity measures are improving, what you are doing is you are increasing capacity. You're creating more time. And because you're creating more time, you can use these resources to produce more product or produce more services without adding any additional cost. So you will see more revenue. You may not see much cost reduction. Now, on the labor side, you might see some cost reduction. For example, overtime cost might go down. But you're not changing the number of people that work in the value stream. You're not changing the machines in the value stream, so the costs are pretty much the same. So the leading indicator of productivity is linked to increasing revenue rather than some kind of cost reduction. And finally, when the costs of these resources have to increase, that is a function of running out of capacity. So if you don't have enough capacity, you have to add more resources. If you hire more people or you buy more machines, your labor cost will increase. If you're buying more machines, that's a capital expenditure, and your depreciation may change. But it's also important to remember, if you have to purchase more capacity, you probably have the demand, which means your revenue is going to go up. Now, the beauty of a value stream income statement is that it will show these relationships. Standard costing-based income statements do not show these relationships. So that wraps up the cost analysis, and we're moving along at a pretty good pace, which is fine. And so I have a couple wrap-up slides, and then we'll go into questions. So the importance of a value stream income statement is related to the principles of lean. Principle number one of lean is customer value, delivering customer value. What that yields, if you actually deliver value, is revenue growth. And the value stream income statement will show that. Principle number two for lean is value streams. And as I mentioned a few times, value streams are the true profit centers of your business. So you want to present profitability by value stream on an internal basis. Lean companies try to maximize the flow of all products through a value stream. Lean operations, they don't pick and choose this product or that product and try to flow it better. They look at the value stream as a whole because all of their improvement activities are designed to make everything flow faster. So this is why lean operations really, they don't care about product cost or how much product profitability is improving. They know that if all of the products flow, we will make more money. So from a lean accounting viewpoint, we want to look at value stream profitability, and we have to accept the fact that if we increase flow, we'll increase profits. In terms of continuous improvement, if we eliminate waste, we will control our costs, we might achieve some cost reduction, and we will be a low-cost producer. It's the dream of every company to grow revenue and be the low-cost producer in your industry. Lean principles, practices, and tools, when deployed in a business, create that opportunity. And finally, the fifth principle of lean is empowering employees. A value stream income statement is designed for non-financial people, your internal customers, operational people, senior level people, and other people. So accounting, by creating value stream income statements and distributing them, is really delivering value and serving your internal customers. Value stream income statement aligns with lean principles in a more detailed level too. Profitability in a lean company is primarily driven by increasing demand by creating value. Costs are primarily controlled by understanding capacity and improving performance. Again, value streams are the true profit centers of the business. We want to look at our cost structure by actual spending by value streams. Flow and pull. Increase flow, increase profits, increase flow to manage your costs. Continuous improvement eliminates wastes and improves performance and manage costs. We empower our employees through easy to understand and accurate financial information, operational accuracy, and we create this direct relationship between operating performance and profits. So that wraps things up. And before we get to questions, I wanted to just talk about some of the things that BMA does in terms of services. And it's pretty basic here, but we do on-site training, 1 or 2 day workshops for companies. We also do a lean accounting assessment where we would come in, visit your company, perform a current state analysis of where things are, and prepare actual recommendations for moving forward with lean accounting. And this lean accounting assessment sometimes is also can be combined with the on-site training. We also offer pilot implementation services. So this is anywhere from 4 to 6 lean accounting Kaizen events to help you create a lean accounting pilot for your company for one value stream or one location. Each of these Kaizen events is 3 days. Depending on how deep you want to go into lean accounting, that's why it's either 4 to 6 events. We also do public workshops. So this would be our 1 day workshop or our 2 day workshops. We do these for conferences, for industry groups, for lean groups, etc. So that's just a general overview of the kind of things that we can do for companies that are interested in moving forward with lean accounting. So now let's go to the question section, and I'm going to open up my pane and take a look at the questions. And as in the previous webinars, I will read the question and give you the best answer possible. So one person just asked me a general question about not being able to join the second session. And Klaus, if you can hear me, send me an email to my email address and I will send you a link to watch the recording of the second session. So Charlene Budd has asked me a few questions. So the first question is, does lean reconcile internal value stream revenue with external GAAP accounting reports? The short answer is yes. A value stream income statement can be reconciled back to the external report, the GAAP financial statement. The primary area of reconciliation is the inventory valuation, but that really is a role of accounting, is to reconcile it. And Charlene actually asked me a follow-up question, is the lean net income amounts reconciled with GAAP? Yes. All of the numbers are coming out of the general ledger, and it's not hard to reconcile it, and you can create some standard work around it. Next question is from Kevin Fitzgerald, and his question is, can there be cascading value streams, order fulfillment value streams with maintenance or production value streams underneath? This is more of a lean question. Typically, maintenance is not considered a value stream. Maintenance is considered a support function that supports all the value streams. Purchasing is not considered a value stream. And again, it's really important to understand why we want to organize around value streams. Kevin, if you have any more questions about value streams, it's probably best like for a phone call or something, because you might have some specific instances in your company that I could help you with. So Brandon Kim has asked me a couple questions. The first question is, how do you adjust the value stream income statement and inventory transfer costs for component facilities supplying sister plants? That's a very good question, because sometimes one plant produces parts and you ship them to another plant for final assembly into some finished goods. So in this case, you can create like a transfer line in your value stream income statement and show the some kind of transfer cost going in and out. So Jeremy, his question is, can I give a brief explanation between standard cost, activity-based costing, and value stream income statement? So standard costing is a system where product costs are created at some standard based on labor rates, material cost, overhead rates, and production run rates. And the individual product costs are primarily used to value inventory. But they can also be used to look at product profitability, business unit profitability, etc. Activity-based costing is really a more detailed type of analysis of activities where you want to understand what is driving the overall cost of different parts of your business, such as purchasing and engineering, even production. So it gets into details. What are the drivers of costs? And activity-based costing is complex. I really don't have any experience with it. But again, it's much like standard costing in that there's a lot of assumptions based on what the cost drivers are and how much the cost drivers contribute. The value stream income statement is based on actual costs, and that's the primary difference. So another question here from Bruno. For companies with short lead times, this seems like a good approach. However, what has to be done to ensure that even in multi-year project transactions with possible early material purchases, such as products with long lead times, do not give operations a distorted picture? Very good question, because not all products are produced in very short lead times. So this is where, in terms of the material content, what you have to make a determination is what is the material that is consumed by a value stream at any point in time. If you have long lead times, it may not be what is purchased, it may be what is released into the value stream in any period. That's the short answer for how you overcome this. But in terms of your production costs, like your labor, your machine costs, that can still be run on the actual incurred in the period. So Rob Green has a question. He asks, what do you use for actual costs in the period? Is it the material that the value stream purchased and stocked, or the material that was used out of inventory within that period? Good question. If you have raw material, ideally you'd like to use raw material purchases, because ultimately, even at the beginning stages of lean, you have raw material purchases. Over time, that may go down and you have less inventory and you're consuming material in the period that you purchased. That's the best thing to use, purchased. But if you have to use material issued to the value stream, that's also a good assumption. The whole key is to create an assumption and be consistent with it. So another question from Jeremy Campbell is, do I have leading and lagging indicators within a balanced scorecard. So balanced scorecard uses perspectives from operational, customer operations, learning, and growth. Balanced scorecard is a performance measurement system that's been around for about 30 years. And our lean performance measurements really can be incorporated into a balanced scorecard. And I have a couple more questions. I'm going to try to get to them. One question from Tom Murphy. If a business has a strategic pillar of competitiveness, what leading indicators and financial outcomes do we want to drive? I would say competitiveness is about how do you create value better than your competition. So you have to understand what the customer value propositions are for your industry, how you need to be able to measure that internally, and understand how to drive it down. Understand how to improve the measures so that you are creating value better than your competition. If you're creating value better than your competition, you should achieve above average revenue growth. Peter Baxter asked a question about product development costs. How should costs like new product development be kept out of the value stream income statement? In a lean organization, new product development is a value stream unto itself. And there's lots of literature about lean product development. The lean product development value stream is typically from product concept to product launch. Once a product is launched, then the order fulfillment value streams produce that product. How does lean treat excess capacity? What lean wants to do is they want to use that excess capacity to spend more time on value-added activities and create value. And I'm not going to be able to get to all the questions. So let me see. So Rob Green had a question, and this will probably be the last question, that we started lean accounting and plain English financial statements a few years ago. Our outdated financial system made it very difficult with multiple cut pastes to create value stream income statements from the general ledger. They're implementing a new ERP system which should help the general ledger transactions. Any advice as we are in ERP setup to make sure that we are supporting a lean financial system? This is a great question. My advice to you is that in your ERP system, set up your value streams based on the way your ERP system either sets up departments or cost centers. That's what I would do first, and make sure those are your value streams. Those are value streams. Set them up, and then it's very easy to charge all of your transactions through ERP to the various cost centers, which are your value streams. And so I think that's really it. We're at the wrap up. If I didn't get to your question, please send me an email. I'll try to answer it. I'd like to thank you for attending. We will have session number 4 on Thursday, which will be about lean decision making and how we bring this idea of the box score together and make good business decisions in a lean environment. And tomorrow, you will be receiving a follow-up email, which will have a link to the recording, whether you have attended this session live or have registered for it. So have a good day, and we'll see you on Thursday. Bye-bye.